Florida sellers aren't slashing prices, they're vanishing. Listings are getting pulled, deals are freezing, and everyone's calling it stability. It's not. It's a standoff. Today I'll show you why inventory looks tight even though buyers are ghosting, how two nearly identical homes can be $100,000 apart, and why a 2.2% year-over-year price drop doesn't tell the full story. If you're a seller holding out for 2021, or a buyer staring at 6% rates and bloated HOA fees, you're in the right place. The market isn't crashing, it's flinching. Let's unpack the rules of this game. Before we continue, hit subscribe so you never miss the latest updates. You're seeing fewer active listings and thinking, stability. Here's the twist. Sellers aren't selling, they're ghosting the market. They're not capitulating, they're hiding. And the portals make it look calm because the chaos stepped off stage. Let's break the pulled listing playbook. A seller hits day 30 with crickets. Instead of cutting $5,000 and signaling weakness, they pause. They yank it. The story they tell themselves is simple. Wait for spring, wait for a magical rate dip, wait for the snowbirds, then relist with a cleaner slate, swap a few photos, maybe tweak the description, and hope the algorithm forgets. That's not strategy. That's stall and pray. Meanwhile, buyers are doing their own freeze. 6+% money wrecks the monthly. Insurance quotes come back like a jump scare. HOAS that used to be background noise now creep every year and sometimes every quarter. Showings thin out. Weekend open houses feel like a diet version of last year. Same cookies, half the people. Sellers refuse to blink because they still believe in that one unicorn buyer who gets it. So the active pool shrinks, but not because homes sold. Inventory retreats. Think of a retail store locking the doors so it doesn't have to put everything on the clearance rack. The merchandise didn't disappear. It's just not for sale at the price that clears. I've been scanning local MLS snapshots, and the pattern is consistent. More withdrawals and more cancellations than a typical year, fewer price reductions, more quiet exits. Palm Beach is a perfect example of the paradox. High active counts that look healthy at a glance, but a growing share slipping off market when offers don't match the fantasy. On paper, available. In practice, try again later. Here's a simple tale. Two near twins on the same block. Same builder, same square footage, similar lots. One hits day 45, the seller gets an offer with inspection credits and a rate buy-down ask. They pass. That listing disappears. 30 days later, it pops back with a fresh clock and the same price. New cover photo, new vibe, same math. The second home listed a touch lower stays live, absorbs feedback, trims strategically, and keeps accumulating actual showings because it doesn't vanish when the market nudges back. This vanishing act screws with price discovery. Fewer active comps, more gaps between what appraisers can justify and what sellers want to believe. Valuations get fuzzy because closed sales reflect deals from months ago, and the current reality isn't leaving a clean paper trail. When the listings you need for context go dark, buyers pull back. They don't want to be the lone guinea pig writing the first real check in weeks. That uncertainty becomes the hidden fee. Lenders tighten a touch. Appraisers stay conservative. Buyers stack contingencies because they sense the instability. And sellers, they cycle through the pause and relist loop, which delays the inevitable. A deal that matches the monthly payment people can stomach with Florida taxes, insurance, and HOA baked in. So if the shelves look half empty, why aren't prices falling in a straight line? Because the real negotiation moved off stage. You don't see the rejected offers, the credits that would have made it work, the financing plans that died on condo questionnaires, or the buyers who backed off after the insurance binder. You just see temporarily off market and a suspiciously clean DOM when it returns. Let that sink in. The calm isn't strength, it's retreat. Less visible supply doesn't mean demand soaked it up. It means a chunk of sellers would rather sit in timeout than face the math. That's why you feel the fake calm and not the true clearance. What this creates is a curated shelf, the Instagram version of a market. The pretty homes stay up, the overpriced ones disappear like they never existed. The stale inventory gets a makeover and a new timestamp. The data you rely on to make offers turns into a funhouse mirror. And if you're a buyer, that's disorienting enough to slow your roll, which is exactly what the ghosting sellers want, while they wait for an interest rate miracle that may not arrive on schedule. The mini payoff is simple. Tight inventory right now isn't a victory lap, it's a timeout. A lot of sellers hit pause, not sold. That's why you're feeling a standstill that reads as stable but acts like a stalemate. Real supply didn't vanish, it ducked behind the curtain. And if the shelves are curated, wait until you see the pricing chaos on what's left. Two homes that look like twins won't price like twins once carrying costs and risk premiums start doing the talking instead of the backsplash. How can two nearly identical houses in the same zip code be 6 figures apart? You're not ready. Same builder, same floor plan, same block even. The gap shows up when one side is living in the 2021 and the other side is doing math in 2026. Here's the anchoring war. Sellers keep staring at the peak comps like they're carved in stone. Those were zero-down vibes with cheap money and FOMO on tap. Today's buyers price in 6% mortgages, hurricane deductibles, rising taxes, and an HOA that reads like a cable bill bundle. Two different realities collide on one street. Appraisals don't rescue high hopes either. They trail the party because they rely on closed sales, not the wishful list prices your cousin's agent wrote on a napkin. Listing agents try to paper over the gap with unique features. A shiplap wall isn't a feature. An outdoor kitchen with a cracked slab isn't a feature. Buyers counter with insurance quotes and HOA add-ons that hit the monthly harder than quartz ever will. Let me give you the side-by-side, House A and House B. Same square footage, same elevation, same builder from the last boom. House A is owned by a seller who's anchored to the highest comp from 2 summers ago and won't give it away. House B is owned by someone who actually called their insurer and got the premium, got the roof wine mitt report, and priced the monthly to land a funded buyer. House A sits high, fields lowball cash, and a few financed offers with credits that would make it work, then ghosts when it's time to concede. House B lists a click under the herd, advertises a seller credit toward a rate buy-down, and moves. Now the appraiser. They don't get to invent value because the backsplash is trending. They pull comps that closed 60 to 90 days back. That's a softer period, with concessions that may not show on the HUD the way you think. They make adjustments for square footage, age, condition, and big-ticket items like the roof and pool. Outlier listings don't help. They distort expectations but not the valuation. If the comps are mixed, the number lands conservative, which turns your over-ask fantasy into a financing problem. Data tells on this. Look at list-to-sale price ratios slicing across Florida metros, and the spread widens. Some homes sell near ask, others need chunky credits or cuts. That volatility signals a simple truth. Buyers and sellers don't agree on value. When agreement collapses, the spread yawns open. That's not vibes. That's a market with inconsistent price discovery. Micro factors pour gasoline on it. Flood zones. A small shift from X to AE can mean a premium that nukes your budget. Roof age is huge now after all the insurance crackdowns. A roof past its magic birthday might be the entire difference between approved and nope. Condo reserves? If the association underfunded them, your lender either hikes the rate, demands a bigger down payment, or bails. Even in single family, the little stuff stacks up. Shutter rating, electrical panel brand, cast iron plumbing rumors. Tiny differences, massive pricing consequences. If nobody agrees on price, what happens to speed? It dies. Days on market climb. When they climb too high, the realist trick kicks in to hide the scar tissue. New photos, fresh date, same house, same carrying costs. Time doesn't fix math, it just disguises it for another 30 days. Let that sink in. Two identical homes are not the same when the monthly payment and risk premium diverge. House A with a 17-year-old roof in a borderline flood zone and a wobbly HOA ends up a $100,000 headache compared to House B with a newer roof, wind mitigations, and stable reserves. The difference isn't granite, it's underwriting. It's renewal quotes. It's the certainty that the payment won't explode next spring. So you see the $100,000 gap, and it looks irrational until you line up the bills. Insurance at $7,000 versus $3,800. HOA that used to be $450 is now $725 with whispers of a special. Taxes reset at the new purchase price and bite harder than last year's Zillow estimate. Add a lender who won't count the pool house as living space, and suddenly the buyer who was stretching at the higher price can't qualify without an ugly rate bump. Value isn't what the seller wants. Value is what a funded buyer can carry without losing sleep. That's your mini payoff. The chaos isn't random, it's math plus risk. Two twins, two outcomes. One seller fights the last cycle, one seller prices the payment. 6 figures open up like a drawbridge. And if you think slapping in an $80,000 kitchen fixes it, you're going to hate the next part because renovations aren't bailing out listings like they used to. And the ROI math is about to get real. That $80,000 kitchen? Cute. But buyers aren't paying a premium for your Pinterest board anymore. They'll compliment the backsplash and still write an offer that ignores it. You can stage the latte machine and the waterfall island, the monthly still shouts louder. During the boom, turnkey meant speed. Cash lined up, FOMO did the heavy lifting, and just move in closed the deal. Today, buyers want a fair price and the option to customize on their timeline. They're not allergic to nice finishes, they're allergic to paying above the number that keeps their monthly from melting down when insurance renews in August. Here's the tension. Sellers expect ROI on luxury finishes like a guaranteed dividend. Appraisers give minimal credit because their grid rewards age, square footage, and condition bands, not your European faucet with an influencer collab. Buyers, meanwhile, run the payment. They'll trade marble counters for a lower rate or rate buy-down credit every single time. Let's do the math that kills the wow. Insurance climbs. Taxes reset at your inflated ask, not your homesteaded dream. HOA fees edge up, sometimes fast, sometimes sneaky, with temporary assessments that seem to outstay their welcome. That $400 bump in monthly costs eats the premium you hoped your kitchen would command. Buyers see the same money buys a simpler house with less risk, then DIY the finishes over time. Case in point, renovated home at the very top of the neighborhood range, slick photos, cabinet lighting that belongs in a car commercial. It sits, tons of saves, polite showings, no funded offers that hit ask. Down the street, the dated twin with honest pricing shaves 10 or 15 grand early, discloses the roof report and closes first. Not because buyers love tile counters, but because the monthly landed in the safe zone. Contractor inflation adds another layer. Labor and materials jumped, and the workmanship got spotty. You can feel it walking through. Soft, close drawers that don't close, tile lippage tripping your shoe, vent hoods that vent into the cabinet like a prank. Buyers have been burned by amateur flips with fresh paint hiding saggy trusses, polybutylene plumbing rerouted temporarily, and ACs set to Antarctica to mask airflow issues. Trust drops, and the premium evaporates. Appraisers aren't the cavalry here. Design trends don't appraise. They'll note updated kitchen as a condition bump, not a price rocket. They adjust for quality tiers only when it's obvious and market supported, and even then, it's modest. Imported tile doesn't sing on the form. A 10-year younger roof does. Impact windows do. A clean 4-point inspection absolutely does. That's the language the lender speaks. So the buyer sees two comps. One is glossy, one is basic. The glossy one asks for a lifestyle tax. The basic one leaves room for a buy down and a reserve for a future roof. The decision isn't emotional, it's survival. A lower monthly beats instant wow because the fear isn't the backsplash. It's the renewal email from the insurer and the HOA meeting where someone says the word assessment and everyone looks at the floor. Here's the analogy. It's like paying extra for a fully loaded phone when your data plan just doubled. The hardware extras are nice, but the bill shock makes you switch to the model that does the job and keeps you out of overdraft. Same house logic, different box, and workmanship risk isn't just a vibe. If the flipper skipped permits or the receipts are in the truck, underwriting gets squeamish. Lenders ask questions. Insurance carriers ask better questions. Suddenly, that sleek bathroom is a liability because the pan isn't up to code, and the drain line hums when the upstairs neighbor borrows your water pressure. So here's the thing. In this rate-driven market, renovations are a garnish, not the entree. They might speed the sale if you're already priced to the payment, but they don't rescue a fantasy number. Affordability wins the tie, every time. If you're a seller, market your monthly, not your marble. Offer a credit toward the rate or insurance. If you're a buyer, don't pay for someone else's taste when the pantry door doesn't close. And the HOA line item just added 20%. You feel where this goes next. If upgrades don't save the listing, maybe condos with amenities carry the value, right? Pool, gym, security, hassle-free living. That's where the friction spikes because the amenity package arrives with a fee sheet that can vaporize your pre-approval faster than a summer thunderstorm. Mini payoff. Renovations no longer guarantee a price lift. Not in this math. The market is paying for certainty, not sparkle. If the monthly works, the house works. If the monthly doesn't, the waterfall edges and wine fridge collect dust while your dom climbs. Speaking of monthly pain, let's open the condo fee envelope together. It's not pretty. A cheap condo pops up and your brain goes, steal. Then you open the HOA, the insurance binder, and the special assessment letter, and it feels like a jump scare. The list price is bait. The bill is the hook. Here's the split screen. Buyers swipe through photos and key on the sticker. Lenders underwrite the all-in monthly. Two different realities. You're thinking, Can I get this for $350,000? They're thinking, can this person carry $3,000 a month without imploding when the association votes on a new roof? Post Surfside, the vibe changed. Associations must actually fund reserves. Insurance carriers reprice risk after every storm season. Deferred maintenance stops being a rumor and turns into a line item on your statement. Stack that on top of the rate, and the sunny listing turns into a heavy monthly. It's real. It's happening. Let's walk the trap. The $350,000 looks fine on paper. Then you catch the $900 plus HOA. Insurance isn't the friendly number from last year. It's the new buyer rate with no homestead cushion. The association drops a temporary special for concrete, balconies, elevators, or a roof replacement nobody wants to talk about during showings. Your lender tightens the condo underwriting, recalculates your debt to income, and suddenly that pre-approval melts. I've watched Miami-Dade and Palm Beach buyers hit the wall here. Absorption slows, units linger, cancellation rates tick up because the final numbers show up late in escrow and kill the vibe. Buyers push back, ask for credits, or walk. Sellers call it fickle. It's not. It's math plus timing. Lenders are a whole subplot. The condo questionnaire used to be a formality. Now it's an interrogation. Do reserves meet standards? Any litigation? What percentage is investor-owned? Are there delinquent dues? One red flag and your financing either dies or your rate jumps into the "are we serious" bracket. Reserve studies get scrutinized. If the building is playing catch-up, the underwriter assumes risk and prices it into your life. This chills comps fast. Fewer financed buyers can even play, so the field narrows to cash or bigger down payments. Cash buyers know they're the last ones standing and they bid like it. Lower offers set the tone, and recorded sales start reflecting the discount. Meanwhile, the units that require financing linger, get relisted, or wait for a unicorn. Here's the analogy. It's like seeing a cheap flight and then getting whacked by baggage, seat selection, and fuel surcharge. The base fare means nothing once the fees pile up. Condos are the same. The list price is just the base fare. The HOA, insurance, reserves, and assessments are the baggage you can't leave at home. Let's do a tighter example. 2 one-bedrooms. Same floor plan. Unit A is $350,000 with $925. HOA building in the middle of a concrete restoration with a $12,000 special spread over 24 months. An insurance that forces a higher HO6 because the master policy deductible jumped. Unit B is $365,000 with a $550 HOA, healthy reserves, and no litigation. On a lender worksheet, Unit B wins every time because the payment stabilizes. The $15,000 list gap is irrelevant next to a $400 monthly swing. Let that sink in. The underwriting friction is the quiet killer. If a building fails the limited review and needs a full review, your timeline stretches, your stress spikes, and your rate can ratchet with the extra overlays. Some banks simply blacklist certain associations. That's not rumor. That's policy you only discover after your file gets escalated. Buyers feel boxed in. They either accept a building with clean books and pay more upfront, or chase a deal and get hammered by fees and uncertainty. Sellers feel insulted by the offers because they're anchored to last year's closings that didn't factor new reserve targets or the fresh insurance bill. All of this feeds back into comps. With fewer financed deals, the dataset tilts toward cash. Cash doesn't need appraisals to land, so it can clear at a lower number without drama. Then next month's appraisals pull those lower comps, and conservative adjustments nudge values down again. It's a loop, so here's the mini payoff. Condos amplify Florida's affordability shock. They look cheap on paper and turn into no thanks in underwriting. The monthly, not the sticker, decides everything. And the buildings that haven't fixed the books yet, they're going to feel it in absorption, in days on market, and in the size of the credits needed to move a skeptical buyer to the closing table. Which leads to the headlines you're hearing. 2.2% down year over year and 13,000 actives. Sounds mild, but condos wobbling changes the mix, the comps, and the meaning. Let's decode what those top-line numbers are hiding. A 2.2% drop sounds mild, right? But here's the catch. Averages hide a knife fight. The top-line number is a weather report. It tells you cloudy. It doesn't tell you about the tree branch aiming for your windshield. In this market, the branch is the mix shift, the ghosted listings and the concessions that never show up in the headline. You see a snapshot about Florida softening and Palm Beach loaded with actives, and it reads like a yawn. But here's what nobody tells you. That snapshot mashes together condos with shaky reserves and single-family homes with new roofs, cash closings and borderline financed buyers, withdrawals that never hit the sold column, and relists that pretend to be fresh. The average drags all of that into one bland number and calls it a day. The mix is doing push-ups. Fewer financed condo buyers can clear underwriting, so those units linger or get yanked. Sellers in single-family land don't want to print a low comp, so they withdraw instead of cutting. The result? Fewer recorded sales with big concessions, more invisible standoffs off-market, and only the cleanest deals making it onto the scoreboard. It feels stable until you actually try to buy or sell. Composition effects do the rest. One month, the higher-end stuff slows because jumbo buyers are waiting on rate clarity. Next month, a handful of cash closings at the top end hit, and the average skews up even if the middle sagged. Meanwhile, the listings that would have shown true pain pulled. They don't show up as sold with a giant credit because they never sold. So the worst concessions get erased and the data looks calmer than the conversations happening in inspection periods. Fragmentation across metros makes the headline even fuzzier. You've got neighborhoods holding flat because the roofs are young and flood zones are friendly. 2 zip codes over, mid-single-digit declines because insurance quotes spiked. HOA whispered, assessment. Condos taking bigger hits than single family because underwriting got stricter and reserves must actually exist. The average smooths that all out like a bad Instagram filter. Days on market and price cut rates tell on the situation more than the median. A small price decline can sit on top of heavy credits, inspection givebacks, and rate buydowns. You don't see the seller paying for a new panel, a roof patch, pest treatment, and 2 points to the lender in the median price. You just see a tidy closing number and think, soft but not scary. Meanwhile, the buyer walks away with a binder that reads like a home renovation to-do list paid by the seller. Appraisal friction adds another layer. Appraisers lean conservative when comps are messy and outliers confuse the grid. Incentives get buried off the final disclosures, so the recorded price looks stronger than the net. A buyer gets a $15,000 credit and a 2-to-1 buydown, but the county record still shows the contract number like nothing happened. That's how the average keeps its poker face while the real money trades behind it. So how do you read a 2.2% print in that kind of fog? You don't take it at face value, you look at who's closing. Are the winners cash singles and the losers financed condos? Are the homes that move the ones with WinMit reports, impact windows, and boring HOAs? Are the laggards the pretty listings with old roofs and vibey amenities that cost like a gym membership plus a car payment? That's the real split screen. Here's an analogy. It's like reading the average restaurant rating when half the one-star reviews got deleted and the spicy dishes were pulled from the menu that day. The score looks fine. The experience burns your tongue. Let that sink in. The mini payoff is simple. Headline drops understate the grind. We're seeing fewer transactions, more hidden concessions, and a standstill that pretends to be stable because the messiest deals never become comps. That 2.2% isn't wrong. It's incomplete. The fight moved to the notes section of the contract and the lender worksheet where nobody but the two parties can see it. So if the data is muddy, how do you move without getting wrecked? You focus on the monthly, the risk items, and the timing windows where reality forces action. You use the quiet to negotiate credits that won't appear in next month's median. And you track which segments keep blinking first. Condos after reserve deadlines, single family after insurance renewals, or listings with roofs hitting the end of their warranty. Time to map the game theory. 3 paths this standoff can take next. We're in a staring contest. Sellers squint across the street at buyers. Buyers stare back over their calculators and no one wants to flinch first. You feel the quiet, but it's not peace. It's two sides timing the other's mistake. Here's the setup. 3 paths are on the table. Slow drift down, relist shell games, quiet buyer leverage gain. All 3 are real, and different neighborhoods will run different plays at the same time. The only constant is math. And the math is louder than anyone's memories of 2021. Sellers want the peak. They want the bidding wars, the easy appraisals, the cash that acted like a rumor and closed like a promise. Buyers want the 6% reality to pencil, with insurance and taxes that age like milk in the sun. Rates and insurance don't care about nostalgia. They refuse to cooperate. So the market does what it always does when no one agrees. It drifts, it delays, or it hands leverage to whoever kept their cool. Scenario 1. Slow drift, not a crash. A steady, annoying slide. Think elevator that stops on every floor. You see modest monthly softness, small list cuts, a bit more room on inspection credits, and rate buydowns to get funded buyers across the finish line. Deals have more conditions. Financing contingencies come back into fashion. An offer with a clear path to close beats a higher number with shaky underwriting. Buyers who wait a few months tend to get better terms. Not necessarily a headline price slaughter, but a cleaner net, carpet credit, closing costs, small roof allowance, lender points covered. It adds up without making the public chart scream. Scenario 2. The relist shuffle. Days on market get awkward, then reset with fresh photos and a new angle. Cosmetic changes, no real concessions. Price discovery doesn't happen. It gets postponed. The house looks new to casual shoppers, but the serious buyers remember. Appraisers don't forget either. This shell game keeps comps from catching up to reality, so you get a loop of almost offers, stale showings, and sellers insisting the right buyer just hasn't toured yet. That's it for today. Like the video, subscribe to the channel, and stay tuned for more updates you won't want to miss.